Welcome back to Web3 Quick Bites, the podcast where we break down the big ideas in Web3 so you actually work your way understanding something. I'm your host, Olabisi. And yes, I know, it's been a minute. Life happened, but I'm back. And today we are talking about something that honestly should have been a bigger conversation way earlier: stablecoins. Now, before you click off thinking, I already know what stable coins are. Hold on. Because what's happening with stable coins right now in 2026 is actually wild. This is not a beginner explainer. This is me catching you up on why the entire financial world is suddenly paying very close attention. Let's get into it. Okay, let's start with. But what is a stable coin really? For the sake of our beginners, I want us to do a quick level set for anyone who is newer to this space. A stablecoin is a type of cryptocurrency that's designed to hold a steady value, usually pegged to the US dollar. So one stablecoin equals to $1. Always, that is the idea. The two biggest ones you hear about are USDT, that's Tether, and USDC, issued by a company called Circle. Together, they make up over 80% of the entire stablecoin market. Now, the reason stablecoins exist is simple. Crypto is volatile. Bitcoin goes up 40%, down 30%, all in the same week. Stablecoins give you a way to stay in the crypto ecosystem without riding those waves. You can hold value, move your money, trade on DeFi platforms, all without touching a bank. That was the original use case: a parking spot for your money between trades. But here is where it gets interesting. You see, before I get into this particular segment, we need to talk about what is actually happening in 2026. Stablecoins have completely outgrown that original use case, and the numbers are almost hard to believe. The total stablecoin market cap crossed $315 billion by early 2026. To give you context, that is larger than the GDP of most countries. But the number that really stopped me while doing my research was this. In February 2026, monthly stablecoin transaction volume hit $7.2 trillion. That's trillion with a capital letter T, guys. And for the first time ever, that number surpassed the US ACH network, because that's the system your paycheck, your bill payment, your direct deposits all run on. Stablecoins processed more volume than that in a single month. And Chain Analysis, one of the leading blockchain research firms, is projecting that stablecoin volumes could reach $719 trillion by 2035. What they are saying right now is that stablecoins could rival Visa and MasterCard in total payment volume by 2039. Now, I want you to sit with that for a second. We are not talking about crypto as a speculative asset anymore. We are talking about stablecoins becoming the actual plumbing of global finance. And the big players are not standing on the sidelines. Visa partnered with a company called Bridge to launch stablecoin linked cards that are already live in 18 countries. I mean, yeah, that's true because I have a crypto ATM card, or how would I call it, a crypto card? Yes, that's actually Visa. And I've been able to spend my money on websites for shopping, and I've used it to pay for bills, online bills, a couple of my subscriptions. So yeah, they actually know their onions and they know what they're doing. And then, so just like I said, you can spend your stablecoin balance at any Visa merchant location, and they're actually planning to expand to over 100 countries by end of year. Mastercard is doing similar things as well. MetaMask launched a Mastercard partnership. Interactive Brokers now lets you fund a brokerage account with USDC. Do you know what this is telling us, guys? It's telling us that this is not niche anymore. So you might ask yourself that, okay, this is getting interesting, but why now? This is where we talk about the regulation piece. You see, here is the thing. This did not just happen out of nowhere. A big reason stablecoins are having this moment is regulation. For years, one of the biggest barriers to institutions getting serious about stablecoins was the lack of clear rules. Banks don't like uncertainty. Big companies don't like uncertainty. And stablecoins were operating in a legal gray area for a very long time. That started to change in 2025. The United States passed something called the Genius Act, which stands for Guiding and Establishing National Innovation for US Stablecoins. Yes, I know. They really worked out on that acronym, yeah? But what it did was create the first real federal framework for stablecoins in America. Clear reserve requirements, usual oversight, consumer protections, the stuff that makes institutions comfortable. And the EU, the European Union, UK, the United Kingdom, Singapore, and the UAE, United Arab Emirates, all have their own frameworks now too. What this means, in essence, or what this means practically, is that companies that were sitting on the fence are now building. The compliance risk went down, and suddenly, everyone from JP Morgan to Coinbase to PayPal is deep in the stablecoin game. The Federal Reserve put out a note just this month saying stablecoin market cap has grown more than 50% since early 2025, and they are watching closely. I think you guys know that when the Fed is writing about it, it's not niche anymore. This is getting serious. It's really getting serious and it's about to go down. Another question that I think people will find interesting, or for a beginner who is listening to this, question you're thinking of is that, so what are people actually using stable coins for? See, this is the part I find most interesting. The real world use cases that are growing fastest right now, I'm going to mention a couple. So the first one is cross-border payments. This is actually huge, especially for emerging markets. So let's say, for example, you're sending money from Nigeria to the UK, or from the Philippines to the US, or from any third world country to first world country, or cross-border payments, just like the name, this as the name implies. Traditional wire transfers are slow and expensive. With stablecoins, you can send dollars across borders in minutes with tiny fees, 24/7, no network outage, no bank hours, no swift delays. You see, companies like Lead Bank are already enabling people in emerging markets to receive dollars, convert to USDT or USDC, and send across borders seamlessly. That's the beauty of the blockchain technology. Next is business payments and payroll. B2B stablecoin payments went from under $100 million a month in 2023 to over $6 billion a month by mid 2025. Companies are paying contractors, running treasury operations, managing liquidity, all on stablecoin rails. How cool is that? I mean, how super cool is that? On to the next. Now, finally, let's talk about the yield bearing stablecoins. You see, this is a newer trend that's picking up fast. Instead of just holding a dollar, you hold a stable coin that earns yield, like interest from US Treasury bonds or other assets. You get the stability of a dollar and passive returns. So it's basically a savings account, but on chain. And finally, there's DeFi, decentralized finance, which still accounts for the majority of stablecoin usage. Lending, borrowing, liquidity pools, stablecoins at the backbone of all of it. Now, I mean, it sounds all perfect, like everything is going all rosy and smoothly, and you think, "Eh, who could go wrong?" But you see, the honest reality is that it is not all perfect. I am not just going to hype this up without giving you the full picture, because that is not what we do here. On this podcast, we give you the complete full picture. Despite the good side of it, oh, it's amazing, you move your money in seconds, mm, there are also real challenges. You see, consumer adoption in developed markets is still slow. If your banking system already works well, like if you're in the US or Europe, there's less urgency to switch. User experience, fraud protection, and custody are still not as smooth as what you're used to with your banking app. Then there's also concentration risk. The world stablecoin market is basically dominated by two players, USDT and USDC. That is a lot of dependence on a small number of issuers. And interoperability is still a pain point. Moving stablecoins across different blockchains or off chain into fiat is not always seamless. These are real problems that the industry is actively working on, but they are worth knowing about. So, here's the bottom line, guys. Stablecoins started as a parking spot for crypto traders. Now, they are becoming the infrastructure for how money moves globally. $315 billion market cap, $7.2 trillion in monthly transaction volume, outpacing the US banking payment system. Visa, MasterCard, BlackRock, JP Morgan, all building on stablecoin rules. A federal regulatory framework now in place. And projects that will have sounded like fiction just 3 years ago. This is the moment where stablecoins go from something crypto people like to talk about to something your bank now has an opinion on. If you're building in Web3, working in DeFi, or just trying to understand where money is going, you need to be paying attention to this space. And that's your quick bite for today. If you found this episode useful, I want you to share it with someone who is still confused about what stablecoins are, even though this episode was made for them. I kid you not. Share this with them. This episode was made for them. And if you haven't already, I want you to subscribe wherever you're listening so you don't miss the next episode. I'm Olabisi, and I'll catch you in the next episode. See you soon.